G'day and welcome to the Farms Advice podcast with your host, Jack Creswell. Whether you farm it, service it, or just love it, this podcast is for you. We'll bring you the techniques and technologies you can implement into your day straight from the leaders and innovators themselves. Spread the Farms Advice so that we can reach more farmers right across Australia. Follow us on all of your socials at Farms Advice and let's get into this episode. Before we get started, just to let you know, this episode is intended to be general information only, as the host and the guest do not know your personal circumstances, so please go and talk to your own accountant or the team at Byfields to get the right information for your scenario. Let's get into this episode. Welcome back to Beyond the Tax Return with the team at Byfields. We've got Eamonn Lanagan in the virtual studio. Eamonn, great to have you on today.
Thanks for having me, Jack.
And is it twice you've been on now?
I think so, yeah.
Yeah, so frequenting the airwaves a fair bit, but also dishing out some good farms advice out there so people can have a listen to wherever they are in the paddock or in their own office. So today, off the back of last week, talking about the budget, what is in it for Australian agriculture and farmers precisely?
All right, Jack. Well, yeah, I'll run through quite a few things there that came out of the budget that really targeted around agriculture, those people on the land and those in rural communities.
Yep.
Try not to get too political or get into any of that sort of stuff. Keep it a bit lighter. Yeah, probably the big thing that's come out of the budget and sort of with some changes there is the end to temporary full expensing. So, yeah, temporary full expensing has been really good for farmers, the economy, rural businesses, machinery dealers especially. I think they've done pretty well out of this.
Yep.
So basically, yeah, as we currently stand through to 30 June 2023, if you're a business in Australia, as long as you turn over less than 5 billion, which I'd say is most farmers out there,
yep.
You can claim a full tax deduction for any asset purchases that are depreciable. So yeah, you buy the new tractor, you buy a new header, you can just claim the full deduction for all of that.
Yep.
I suppose, yeah, it's been great for the last couple of years. We've been able to write off all that depreciation. There hasn't been a heap of tax paid and there's been the ability to invest in businesses. So yeah, it's been really good. I suppose where we're at now is at 30 June 23, that comes to an end. And we go back to the old rules. The old rules are if you're under $10 million of turnover, that you, in the first year of purchasing an asset, you can claim 15% depreciation and 30% of the balance thereafter. And it all goes into the pool. If you're over $10 million, which over the last few years, there's probably quite a few farmers out there who've pushed over that threshold with a couple of great seasons across Australia. You basically go back to depreciating every asset depending on its effective life and either doing an assessment of that yourself or using the tax office stipulated lives of machinery and the like. So let's say you build a new shearing shed from the 1st of July 2023. If that was on hand constructed all before 30 June, cost you 400 grand. You could claim a full deduction for that. From the 1st of July this year, you'll have to depreciate that over 40 years. So it's a big change there.
Why is it depreciation over 40 years?
Just because that's the effective life of a shearing shed, because it's a structural improvement. So, yeah, like let's say a header or a tractor, that's 6 2/3 years, I think is the number there. So, yeah, it all comes back to the actual asset that it is.
It's probably a big one, but also planning off the back of that. What's something that you should probably plan if you haven't started to plan? Or is there nothing to go off that?
I think, yeah, well, the big one's been like there's a lot of clients out there who have ordered machinery. It's been promised to them. It's been on a boat for the last 8 months, obviously touring all over the world. And now it's either not going to be here in time or it's not going to be on farm and ready for use in time, which is what it's got to be. I suppose the planning really comes down to, well, any purchase there you're going to have to write off the depreciation. So it comes down to, like, if you're doing a trade, writing down the trade-in value a bit. The trade difference is going to be the same, but the sale value, because that's all going to be taxable now. So it's just writing down that value. That's probably the only planning point. The government has announced that, for those businesses that turn over less than 10 mil, that there'll be an instant asset write-off for low value assets, but that's only up to 20 grand. So you buy yourself a new gen set, something like that, you'll be able to depreciate that straight up. But for those higher value assets, you just have to be over one of those methods we discussed before.
That's instant asset write-off is only on new equipment as well, isn't it?
That'll be for all equipment now.
It is.
So you'll be fine if it's a secondhand, like it's a field bin tractor or something like that.
Yeah, as long as it's new to the farm, it's coming in on.
Yeah. You haven't been leasing it or something like that before.
Yep. So what else is in the budget for us out in regional Australia?
Probably one that's not specifically for regional Australia, but will be handy for farmers, I suppose, with where a lot of people are going. So businesses with turnover less than 50 mil will be able to claim an extra 20% deduction for spending that supports what they call electrification and more efficient use of energy. So let's say you've got solar pumps or more energy efficient machinery, you'll be able to claim an additional 20%. So what that means, let's say you buy a solar pump setup, maybe some farm bots, something like that. It costs you 50 grand. You'll be able to claim the $50,000 deduction plus another 10 grand, so another 20% on top of it, even though you haven't actually spent that money.
Oh, right. So it goes over 100% sort of claiming it back.
Yeah. So you can only claim up to an additional 20,000 a year.
Yep.
But it's just an incentive there just to get people moving to those more energy efficient things. The devil will be in the detail, whether you can buy a new tractor and it's more fuel efficient than the previous one, you can claim that, or we'll just have to wait and see on that one.
Being on the back end of it, do you think like these sort of incentives, are they driven straight from the get-go out of the gates, and farmers are sort of looking, or anyone really that is falling within the small business energy incentive? Like, will people be purchasing solar pumps or something like that, do you think?
I think a lot of it will be like the investment decisions people are already making, just going, oh, that's great, I get a bit of extra deduction there. I don't know that people will be going out and doing things that they wouldn't have otherwise. Maybe they just make sure the new purchase is more efficient than the old one.
Yeah, so just sort of falling into the plan of things and giving us a little bit of a bonus in the back end.
Yeah. There are a couple of other ones like that. So there was last year they announced, or the previous year, the small business technology investment boost. So that was where you got a same thing again, the additional 20% deduction, where you were digitalizing the operations of your business, or like, let's say, going to cloud-based services or subscriptions there. That one runs out at 30 June this year, but it was never actually made law. So we still don't know where we stand on that one. The tax officer's acting as though it's in, but it'll be interesting to see if they actually ever legislate that and we can claim those deductions. And they did a similar thing as well with the small business skills and training boost, so the extra 20% again. But that's got another year to run, so hopefully we'll see something on that before it actually runs out and we've got a bit of surety.
That's probably a good one as well, as like lack of labour within farming, agriculture, especially upskill your workforce for the farmers.
Yeah, that was the general idea, was that while there was a labour shortage, that you'd get people in, train them up, and overall the people in the economy would have more skills and be trained better. So that one, basically you just had to give your employees training with a registered training provider in Australia, and you could claim an extra 20%, and that one wasn't actually capped. So let's say you put all your farm workers through a Certificate 3 in agriculture, you could claim the extra deduction for that. So that was, it was a good measure, but once again, it's never actually been legislated.
Yeah, okay. And moving on to something that probably hit finished end of last year as well as harvest sort of started up and everything with the fuel charges and on road costs. What's that one looking like?
Yeah, so I suppose just to set the scene, where we're currently at with fuel tax credits is 47.7 cents a litre of every litre of fuel you buy. And these days where it's hovering around $2 a litre for diesel in a lot of places, makes things a big chunk of that, like it's almost 25% of the cost is in that fuel tax. The general idea with fuel tax is that it's levied so they can pay for the upkeep of the roads and throughout Australia.
Yeah.
Use it in your tractor, use it off-road, use it in a standing engine. You can claim back fuel tax credits. Use it for power generation because that's not really what the fuel tax is designed for. The other one is that, if you've got a heavy vehicle, so it's over 4.5 gross vehicle mass, you can claim back what they call the road user charge, which is currently 27 cents. That's basically just because, like a prime mover, for example, it's using about a litre per K that it does. It's probably not having the same effect on the roads as a car that's doing 6 litres, 100 Ks. So it's just to equalise that. But from the 1st of July 2025, they're going to decrease that road user charge. So basically, you'll get 7 cents less back a litre for that. So the real effect of that is that freight costs, especially like grain freight and fully laden trucks, is basically going to go up 7 cents per kilometre of travel. So it's going to be a big impost across freight, farming, and just across the economy generally. And probably, the other thing to note there is, like they're moving to this fully electric, or want everyone to go to electric. But those electric cars aren't paying any road user charge because there's none levied on electricity. So it's an interesting one there as to how they're going about it and whether or not there'll be a plan going forward.
Yeah, it doesn't really seem like that would be the best rollout, and also electricity within regional Australia is not always the best. And the distance wise, it's a bit unerving for I don't know, going between town and town, even in an electric vehicle. You sort of got a forward plan and everything.
Yeah.
And talking about electricity, you got the energy price relief plan that's
Yeah,
coming.
so that's come out in the budget. So basically, if you're on a concession card or you're receiving an eligible government payment, that's something like family tax benefit or income support, and you also the name on the electricity bill. You'll be eligible for bill relief. So the eastern states of Australia, that's $500, and it's $350 in WA where we are. Also small businesses, and there's various levels of energy use. So in WA, I know it's 50 megawatt hours, and you've got a separate meter for your business. You'll get it's $650. So that's across most of the states. I know Victoria's got a slightly lower rate because they're doing a relief through the state government as well. So I suppose it's just there's a little one-off hit there that's automatically applied against the electricity bills. So I suppose it's just a little bonus for those who are eligible. But I'm not sure where that small business use will really cut out.
Yeah, okay. And then probably overall, what else do we have in the budget left for us in regional, or even more precisely us as farmers? You in the business end of it?
Yeah, I suppose there's a few changes that they've announced. One that's I don't think going to fill a lot of people with joy is payday superannuation. So from the 1st July 2026, you not only have to pay an employee's wages when they're due, which we all understand that needs to be done. At the moment, you pay their wages, you withhold the tax and remit that once a quarter. So from the 1st July 2026, you're also going to have to pay the employee's super at the same time and report that live to the tax office. The issue there is going to be that, they haven't really got single touch payroll all sorted out. I know those farmers who are on legacy programs like Wage Master are struggling with single touch payroll still. And yeah, basically the government wants more and more information out of us for that. The other thing they've announced while we're on superannuation, or employee superannuation, is just more funds just to really check on that. Basically, as we currently stand, superannuation is due at the end of the quarter. You got 28 days to pay it. If it's paid late, it's not tax deductible. And you've also got to pay interest to the employee's superannuation fund. So, yeah, and along with that comes a calculation statement that the accountant's got to lodge to the tax office, which is a pain. And usually where it's a little bit late, this doesn't get done because we say, oh, it's fair enough, it's deductible, but the tax office is going to be doing data matching and they really want to catch people out on this. The other thing, which is a bit iffy, in my opinion, is they've announced they're going to pay bonuses to ATO employees for identifying late super payments. So we don't know how that's going to work exactly, but yeah, you can imagine that some eager ATO employee is never going to let you off with being one day late. They're in there for the kill from that point forward if they're getting money for it.
That sounds like the worst KPI for small business.
Yeah. Yeah, well, this is a problem that people who are trying to do the right thing, and let's say some super bounces back and doesn't get paid on time because you've left it to the end. Yeah, where are you going to stand with that?
Yeah, definitely. And I think that payday super will bring 2026. It's coming in, so we've got a bit of time to sort of ready ourselves and everything. But
yeah,
a few more transactions coming as well. Is there much benefit to employee and employer?
Yeah, I think like the employee, I suppose they're getting money in their super fund earlier, so it's going to grow a little more. But yeah, from the employer point of view, it's just more work to do. It's more transactions to be done. And yeah, if you're not fully automated and you haven't got a good payroll solution, I can see this being very hard.
Yeah, and actually our last episode with Peter Barker talking about apps and software for single touch payroll and everything like that. There's a few in there that may be able to help out in the long run.
Yeah, I think you've really got to move towards doing it properly and not just having a wage book and paying and trying to catch it up in the software later.
Yep. Yeah, definitely. And covering super off, a fair few points on that one. That next one, that was a question in my head about how that would impact. Because initially hearing that, I was like, oh, won't matter too much, but yeah, it's probably pretty big for farmers.
Yeah, so the super account balance is over 3 mil. One is probably going to be the big one that's going to affect farmers.
Yep.
You look at the growth in land prices across farmland across Australia over the last few years, it's been phenomenal. Someone who, let's say 10 years ago, put some farmland in their super, doing the right thing for their retirement, put it in there, it's grown out of sight. Let's say it's $1 million now, it's getting towards the $3 million level, which is quite foreseeable in some areas. Basically, the government's confirmed its intention to levy an extra tax on that, and this won't be a tax on earnings like if you sell it or a capital gain. It'll be on the change in value. So, I suppose it probably sounds a bit worse than it actually is. Like, what'll happen from a planning point of view is on the 30th of June 2025, right before this comes in, all the farmland's going to get valued, and it's going to get valued right up. And it's going to provide an opportunity to reduce any further gain thereafter. But yeah, I suppose what we need to see is how this tax is going to work. And the problem will be with, if you've got a super fund that's just got farmland in it, how are you going to get the cash to actually pay that? And if it's your pension and you're using the lease from that farmland to subsidize your retirement, how's it all going to work? Let's say you go to sell that down the track, is that tax you've already paid, is that going to be offset against any capital gains tax? We're waiting to see on that one.
Beautiful. Well, not necessarily beautiful for everyone, but the next one, the amnesty for small business. Yeah,
so I suppose this is they roll out something like this most tax times. Basically, what they're trying to do is they're trying to get anyone who's a small business, turnover less than 10 mil, who hasn't lodged their tax returns basically since the COVID days. Maybe they've fallen out, maybe they haven't got to it. Trying to re-engage those people in the tax system. So giving them an amnesty from late lodgement penalties, basically, so they come and lodge their tax returns by the end of this calendar year. By the end of this calendar year, that they'll waive those penalties. So if you got a bit behind, and it's only for income tax, this if you've got late BASs and the like, you can't do it for that. But if you are a bit behind, this is a good chance to catch up and do it without penalty.
Righto. And then pension drawdowns. What's this one about?
Yeah. So basically, back to the super funds. You've got your super fund there for the COVID years. You've basically had a bit of a holiday on having to draw down on your pension. So let's say this is the classic ones where you got farmland, your super fund. You've got to draw, and you're using it as a pension. You've got to draw down a certain amount each year. So let's say you're 75 years old. You got to draw, and your super fund's worth $1 million. You've got to draw 60 grand out each year.
Yep.
That's fine where you've got $100 grand lease, but you're probably not getting that on $1 million worth of farmland. So this is where it's been great, because last year it was only 3% for that 75-year-old. It comes back to this issue of you got some good assets in your super fund, but you haven't got a whole lot of cash, and it's going to start running out quicker and quicker.
So something I'll have to deal with a bit later on in life, but I imagine as the boomers sort of get nearing to pension age,
so I suppose it's all part of this move to move away from self-managed super funds, I think, because if you've just got your money in a Australian super or something like that, it's easy enough. You sell up your assets and trade down. But if you're got your money in a self-managed fund with some farmland in there, it does make things quite a bit harder.
Yeah. And moving to stage 3 personal tax cuts. Was this brought in by Malcolm Turnbull, or was it Scott Morrison's? And now it's going to be.
Yeah, so this is one that was bought in a few years ago. Stage 1 and 2 is already in, and stage 3 is the higher income earners. So the Greens came out a couple of days ago and were all over this, saying that it's going to cost $313 billion over the next 10 years. Well, the first 10 years, and it's increasing. I suppose that was sort of the point of why they were bringing this in, just to stop that bracket creep. The other idea was, so people had a bit more certainty as to what tax they were paying. Like beforehand, we had a 32.5% rate. We had a 37. Well, we currently have a 32.5% rate, a 37% rate. I suppose now, basically, you earn, as it's legislated, if you earn between 45,000 and 200,000, you know that you're going to be paying 30% tax on any income in that bracket. Yeah. And then if you're over 200,000 or more, you're going to be paying 45% plus your Medicare levy. So the general idea was that the tax system was a bit more visible. People understood a bit better what they were paying, and to give everyone in the economy a bit of a tax break.
Yeah, okay.
But yes, we've got one more budget there before they come in, so we'll see how that goes.
Cleaning up those tax brackets a little bit there as well. But that one more budget, we'll see how it all sort of pans out. It may change completely off the back of that as the Greens go. But what else is on the list of what's impacting us?
Yeah, I suppose one for that a lot of people, it's sort of a tax hike by stealth, is there was a low and middle income tax offset. So that just hasn't been renewed. The problem was that at the start of the financial year, a lot of, if you're earning wages, a lot of people would include that as part of your pay-as-you-go withholding. Yep. Basically, if you're between, anyone on an income up to 126 grand, your tax return might reduce by between $675 and $1,500. So it's just one of those ones that, it was a nice little bonus that everyone had been getting for the last couple of years. And I think, this was a Scott Morrison one that was bought in and everyone got the bonus. But yeah, now we're on the other end of it, and you might get penalised back the other way.
Yeah. So it's not too much of an impact on that one there.
No, not a huge one, but just one, especially for those people who are wage earners,
Yep.
Who are just going to get a bit of a shock at tax time, I think.
Yep. And to round this one off, we've got one left in the budget for us. What's that one?
Yeah, so there's been one issue that's been hanging around for the last couple of years, and it's company loans to shareholders and their associates. So it all started in 2014. There was a review, 2017 budget and 2019 budget. There was these reforms proposed that basically, gave a bit of clarity to money that was allocated to companies or money from companies that was used by shareholders and how those loans were actually going to be dealt with going forward. And there's been over the years a whole lot of changes in this, and there's a lot of hybrid rules. And the idea was just to clean it all up and give everyone some certainty. The budget hasn't said anything about it, and the issue is that a lot of these like the first lot of the arrangements are ending, and we don't exactly know how they're going to be treated going forward. So it's another wait and see. But it's especially with seeing a lot more farmers moving to a corporate structure. It's just an interesting one if they're pulling money out for their own needs and not necessarily paying dividends.
Yep. Yeah, the family farming corporates becoming more prominent at the moment with the way that sort of expansion as well. That rounds off the budget for us. Is there anything from the Byfields team that you sort of wanted within the budget?
Yeah, I suppose probably what we wanted was some sort of transitional arrangement for the temporary full expensing. So it wasn't just a cut off at the end and everyone had to move on. I suppose, just with some of those ones, there's going to be where, you'd ordered a machine and there would have been a net tax saving. There's potentially a net tax cost now if it's not going to arrive till July.
Yep.
That's one we would have liked to see. And the other one is the small business capital gains tax concessions. The turnover threshold for those is still 2 million. I remember when I started at Byfields, we ran some numbers, and I think it was about 60 or 70% of our clients at the time were under that threshold in 1 of 2 years. These days it's about 10%. So it's just really stretching that, and it really hurts family farm succession and having that big capital gains tax cost there if you want to sell up, or you want to pass it on to the next generation, or you want to sell some farmland to buy some other farmland.
Beautiful. And anything else we need to round off for the budget for this year?
No, I suppose one other one there's got a bit of coverage over the last couple of days is the biosecurity levy.
Yep.
So basically, I suppose from a farmer's point of view, they're looking at this and going, well, they're not the ones who've created the risk. They're busy managing the consequences of what's potentially mismanaged biosecurity for previous years and decades. So the government's come out and announced that they want to raise bit over $150 million from farmers in 3 years, or farmers, fishers and forestry. And I just, quickly before this looked up some numbers. So livestock producers are going to pay approximately 50 cents extra per head, and grains levies are going to increase by 10%. Well, 10% of the levy. So it's going to go from 1% to 1.1%.
It doesn't sound like much in the initial sort of stage, but it does add up, doesn't it?
Yeah. I think the thing that Grain Producers Australia are a bit concerned about was, there's been a lot of stuff around FMD and foot and mouth and, some other livestock diseases. But, on this modelling, they're going to be paying 60% of the biosecurity levies from farmers. So are those grain producers going to get back what they've paid for?
Yeah, one of those things, I suppose, a bit of a grey area. It really just sounds like the government sort of cleaning up their Excel sheets, clarifying what the last government sort of left for them and seeing where they can improve it maybe in the next budget.
Yeah.
It's
So,
definitely It seems like there was more in this one for us than there was last time, though.
Yeah, there's definitely more stuff. Yeah, it's one of those budgets where there's not a lot of huge things coming out of it. Not like there was, let's say, 3 or 4 years ago, and some big changes. But yeah, I suppose we're in a bit more of a consolidation phase as far as budgets and those sort of things.
Yeah, we'll have to play it by ear as farmers. Eamonn, thanks for coming on to the podcast. Before, I was meant to ask you before, how's the scenario sort of playing out for planting season over in WA?
Yeah, it's getting a bit dry. There's a few areas that have got some good early rains, but yeah, we could really do with some more rain, especially in the northern wheat belt. Yeah, they're really crying out for it because they didn't get that early rain.
Yeah.
But yeah.
Yeah, likewise over here. It's really patchy though. Like a few mates have had really good runs, and then we're dry as a chip pretty well. One paddock in, a few more to go.
Well, let's hope there's a bit more on the horizon.
Too easy. Well, Eamonn, thanks for coming on to the podcast once again and passing on your own expertise on the Beyond the Tax Return series with yourself and Byfields. Do you know who else from the team is going to be coming on next?
Sorry, Jay, I haven't actually had a look at the roster, but yeah, there'll be a few interesting people with some interesting topics and a bit to say.
Can't wait to hear it. This Farms Advice episode does not stop here. Come and join the conversation on Facebook, Twitter, Instagram, or TikTok, and even join our Facebook group. Go to farmsadvice.com.au for more on this episode and spread the hashtag FarmsAdvice to your mates. If you can leave a review on Apple or Spotify, that will let other farmers find us too. But until then, see you next Tuesday. In the spirit of reconciliation, the Farms Advice podcast acknowledges the traditional custodians of country throughout Australia and their connections to land, sea, and community. We pay our respect to their elders, past and present, and extend that respect to all Aboriginal Torres Strait Islander people today.